In the next 10 minutes, I want to talk about the measure of the market, but I also want to talk about the limitations of our knowledge, the limitations that are imposed upon us by using postdictive tools, and everything we do in markets is postdictive, to look at events that are unfolding in real time. The alternative title for this little missive could also be, I knew that was going to happen, bullshit you did. So our theme is simply this: commentators continually overstate their ability to interpret and assign reasons to the market. This is also true of traders. Traders continually overstate their ability to predict markets and therefore act upon those predictions. Everything we do in markets is postdictive. We are always looking backwards in an attempt to see what the future might hold. As has been said many times, it is the equivalent of driving by only looking in the rearview mirror. The period I want to look at and concentrate on is our recent rise, and we can see this recent rise from June, July of last year, and you can see that the market has had this lovely uptrend. First section was a little bit bumpy with a few retracements along the way, and a retracement in October, November. Post that, we've had this lovely compressed move upwards. We've had this little bit of a hiccup at the end, and I'm going to talk about this hiccup and the impact it seems to have had upon people in a few moments. But this is the period I want to concentrate on. The first thing I want to do is to look at the notion of volatility within markets, and this is important because I look at volatility and why people use it as a predictive tool and its profound limitations. This is the ASX 200 dating back to 2011. Underneath it, I've plotted simply the 30-day historical volatility, and I've run a longer period moving average through that just to smooth it out, just to get a better idea of trend. You can see that volatility ebbs and flows, and it seems like it ebbs and flows with price action. This is the one of the wonderful illusions of trading. In the first part of 2011, we can see that volatility is reasonably constant despite the fact the market is falling. Market slips suddenly in June, July, and volatility goes up. But as the market compresses, volatility begins to slip, despite the fact that we do have some very large daily moves. The period I want to concentrate on is not only the movement from the June-July low, but the movement from November-December. Because what we're seeing, particularly in the movement from November to December, is this compression of volatility during a period of high trending. This has some very interesting implications for traders. This could be considered a perfect move because you're getting strong price action combined with low volatility. You only need to think about what this means for your position sizing to understand why this could be considered a perfect move. If you have strong trend, low volatility, you get bigger position sizes. You're getting a bigger bite. So these are very good moves for traders. But despite this, the key thing here is not the compression in volatility. That's an artifact produced by the current price action. So we come back to price action being the most important thing to us. Volatility tells us a little bit, but volatility is always a postdictive tool. This is the 30-day historical volatility. This is the volatility looking back 30 days from when I generated this chart. So it's important to understand the limitations of volatility. Unfortunately, most market commentators don't. They simply don't get the limitations in volatility. And the moment you hear a commentator talk about the notion of downward volatility, you know that they're a dickhead. And they're a dickhead because there is no such thing as downward volatility. Volatility is non-directional. Volatility is not trend. So you have to be careful about what a tool can actually tell you about what is happening in the market. Volatility is simply change over time. That's it. It doesn't tell you anything other than that. All it tells you is speed and magnitude. It's not trend. There is this perennial confusion of volatility and trend. The two are not the same, and the two do not measure the same thing. Volatility is non-directional. Think of it this way. If I buy a stock at 100 and it has a 30-day volatility of 20%, all that means in the most basic and simple of terms is that my expectation over the next 30 days is that my stock may trade in a range of 100 plus or minus 20. It might spend the entire 30 days trading between 101 and 99. The mere fact that I say that it has an historical volatility of 20% does not mean that it's instantly going to trade down to 80. And this is the mistake commentators make. Listen to any commentator talk about volatility and they get it wrong. Volatility also displays mean reversion. So volatility collapses back to its average values all the time. Not so important for us as equity traders, but very important for options traders. So where does this leave us? Well, it leaves us still within this band. The market at present is trading in a very, very large band. The question is, what does this mean? And my quick and simple answer is, well, not much really. Because we could have made a series of statements about the market at 4,400, but the market in November, December of last year punched through 4,400. One of the problems people have when they look at a chart like this is that they assume that the lines I have drawn, and they're my lines, is that these lines are somehow permanent roadblocks for price. The price will never do anything else. Unfortunately, that's not true. Markets eventually always go beyond previous highs or previous lows. The question is, will you be prepared for that? And my observation of traders over the past few months is that the majority are not. I've lost track of the number of bleating, whining, Nancy boy emails I've received as the markets hit 5,000 with people going, should I sell everything? Well, why would you sell everything? And the only answer I can get from people is that 5,000 seems to be a magic number. Unfortunately, we have no end of peanuts who are telling us that this is the correction we had to have. Well, there's no such thing as a correction we had to have. The market doesn't have to do anything. The market will do what the market does. And the question is whether you're prepared for that or not. But this raises the question of why so many people believe that the moment the market slips, this is a correction we had to have. In part, we can get some of the answer by looking back at volatility again. This is the ASX 200 volatility index. Effectively, this is mapping the implied volatility of a series of options. In options trading, you have a series of inputs to generate an options price. You've got the price of the underlying, dividends, time to expiry, risk-free interest rate, and your volatility perceptions. You can actually drop volatility out of the equation, use the other components and solve for volatility. This gives you the implied volatility. This is where we run into trouble, because people use implied volatility as a predictive tool. It's a postdictive tool because it's using postdictive inputs. So it's telling you what the implied perceptions of volatility were, not what they are. So we're attempting to get some form of future generation, some form of notion of what is happening in the future. There are a few things I need to say about the VIX. The first is it's based upon an option series that has fairly low volume. So that brings all sorts of methodological problems. Any paucity of data causes problems for systems such as this. It is also a tool that is generated effectively by the sell side of trading. The prime drivers of options pricing are market makers. Now, if I'm a market maker, my job is to sell options to you. So what do I face? Well, I face risk. How do I compensate myself for that risk? Well, what I do is I make options more expensive than they should be. How is this reflected? Well, this is reflected in the implied volatility that those options generate. Remember, volatility has the characteristic of mean reversion. This applies to options trading. So if I sell you something at a higher volatility than is otherwise warranted, and that volatility collapses, in options trading, the relationship between an options price and volatility is linear. If volatility halves, then the price of your option, with all other things being equal, will halve. I can buy that back and cover my position. So I might have sold it to you at 50, I can buy it back from you at 25. So we have a tool that is not perfect, but so many people base their presumptions on it. And we can see, interestingly enough, despite the 2 and a bit % fall in the market last week, we've only had a small pop in the VIX, just as we saw that we only had a small pop in historical volatility. So this is not a magic crystal ball. It tells us what perceptions of volatility were. We also face the problem that what is our reference point for volatility? And all I've done here is I've dropped in average volatility since 2008 and average volatility from the beginning of 2012. If I take my landmark as 2008, volatility is quite low. If I take my landmark as being 2012, well then volatility is only just slightly above the average for 2012. Neither tells us anything, and this brings me to my perception of volatility. Here I will defer to George Patton, the somewhat egotistical legend in his own lunchbox, American general of the Second World War. Patton, whilst writing in his diaries, wrote about the French resistance, and instead of simply referring to them as a bunch of cheese-eating surrender monkeys, he said that they were better than expected but less than advertised. And that's my feeling about volatility. You get a little bit, but not as much as you think you get. And it certainly doesn't tell us what to expect in the market. It tells us what we should have expected, and it tells us about changes in perception, but that's all it does. This brings me back to this move, and I want to put this move in context, particularly given the number of emails I've gotten. If we take the June low to the previous high, this is a 28% gain. Simply take the November low to the current high, that's a 17% gain. This move here is a drop of slightly over 2 and a bit %. If you can't handle a market that goes up either 28% or 17% or whatever fraction of that you capture and then comes down 2 and a bit %, but then recovers that, then trading's not for you. And if you want, I can probably find you the telephone number of your local macrame club.